What are options? Options are financial contracts that give buyers the right, but not the obligation, to buy or sell an underlying asset at a predetermined price on or before a specified date. Options are derivatives, meaning their prices are derived from the price movements of the underlying asset, which can be a stock, ETF, index, or other security. There are two main types of options. Call options give the buyer the right, but not the obligation, to purchase the underlying asset at the stated strike price on or before the expiration date. Call options profit when the price of the underlying asset increases. Put options give the buyer the right, but not the obligation, to sell the underlying asset at the stated strike price on or before the expiration date. Put options profit when the price of the underlying asset decreases. The main differences between trading options versus stocks are: leverage. Options provide leverage, allowing traders to control large positions with less capital. While stocks require a 1-to-1 capital ratio, options offer leverage ratios between 1-to-2 to 1-to-5 on the capital deployed. Defined risk. With options, risk is capped at the premium paid to enter the trade. Stocks have unlimited risk if the share price falls. Higher profit potential. Successful options trades can yield higher returns than stocks based on the leverage provided. However, options have a lower probability of profit compared to buying stocks. Shorting ease. Options provide an easy way to profit from a bearish outlook. Shorting stocks can be more complicated than buying puts. Access to volatility. Options prices are driven by implied volatility. Buying options allows traders to profit from volatility expansions. In summary, options are contracts that provide rights to trade underlying assets at preset prices and dates. They offer leverage, defined risk, high profit potential, easy shorting, and volatility access compared to trading stocks. Why trade options? Options trading offers some key benefits for beginners looking to get started in the markets. Here are some of the main reasons to consider trading options. Leverage. Options provide leverage, allowing you to control large positions with less capital outlay. Buying call or put options allows you to profit from market moves with limited downside risk. Defined risk. Options have defined risk, as you can never lose more than the premium paid to buy the option contract. This helps limit losses on trades that don't go your way. Additional strategies. Options give you access to strategies beyond simply buying and selling stocks, such as spreads, straddles, and strangles. These can help manage risk, profit from non-directional markets, and more. Hedging. Options allow you to hedge your portfolio and limit downside risk in the stocks you own. For example, buying puts against a long stock position protects against falling prices. Income. Option strategies like covered calls generate income from stocks you already own by collecting premiums as the options buyer. Speculation. Options provide a low-cost way to speculate on the direction of stocks and benefit from major price swings due to events like earnings. Overall, options provide flexibility for traders of all experience levels. With defined and limited risk, options are a great way for beginners to gain experience trading while managing their risk exposure. The variety of option strategies also offers new traders many ways to profit while tailoring trades to match their outlook and risk tolerance. Options trading terminology. Options trading has its own set of terminology that is important for beginners to understand. Here are some of the key terms. Strike price. The strike price is the price at which the holder of the option can buy or sell the underlying security if they exercise the option. For call options, the strike price is where the security can be bought by the option holder. For put options, the strike price is where the security can be sold. Expiration date. This is the date on which the option contract expires. Options have a limited lifespan, and the expiration date is the day the option expires. If the option is not exercised by the expiration date, it becomes worthless. In the money. A call option is in the money when the strike price is below the current market price of the underlying security. A put option is in the money when the strike price is above the current market price. Being in the money means the option has intrinsic value. Out of the money. A call option is out of the money when the strike price is above the current market price. A put option is out of the money when the strike price is below the current market price. Out of the money options have no intrinsic value, only time value. Intrinsic value. The intrinsic value is the difference between the strike price and the market price of the underlying security. Intrinsic value only applies to in the money options and represents the built-in value of the option. Time value. Time value is the additional value an option has due to the potential for the option to become profitable before it expires. Time value applies to all options and decays over time. Understanding these basic terms is key for any beginning options trader. They represent the building blocks of options trading terminology. How options are priced. Options contracts derive their value from the price of the underlying asset. Several factors influence the pricing and value of options. Underlying asset price. The current market price of the underlying asset is the most significant factor determining an options premium. Options prices generally increase as the underlying asset price increases, and vice versa. Strike price. The strike price is the price at which the option holder can buy or sell the underlying asset if they exercise the option. Options with strike prices closer to the underlying asset's market price typically have higher premiums. Time to expiry. Options contracts with longer time until expiration have more time for the underlying asset price to move favorably, so longer dated options have higher premiums than shorter dated options. Volatility. Implied volatility reflects traders' expectations of how much the underlying asset price may fluctuate before option expiration. Higher implied volatility translates to higher option premiums. Interest rates. Prevailing interest rates impact the pricing of options. Rising interest rates increase call premiums and decrease put premiums. Falling rates do the opposite. Dividends. Upcoming dividends from the underlying asset decrease call premiums and increase put premiums. The most common options pricing model is the Black-Scholes model, developed by Fisher-Black and Myron-Scholes. The Black-Scholes model calculates a fair value price for an option based on the above factors like underlying price, strike price, volatility, time to expiry, and interest rates. The model assumes the underlying asset follows a log-normal random walk and that options can be traded continuously. While the model has some limitations, it provides an influential benchmark for options pricing. Types of options trading. Strategize. Options trading strategies allow you to be more precise in the risk you take and the potential reward you can gain. As a beginner, it's important to understand the main strategies to determine which ones may align with your investing goals and risk tolerance. Covered call. A covered call is a strategy where you already own the underlying stock, and you sell or write call options on that same stock. As the option seller, you get to keep the premium paid by the option buyer. The main benefit of this strategy is it generates income from the premiums and offers some downside protection. The risk is that you limit your upside if the stock rises above the call strike price. Protective puts. Buying a protective put involves purchasing a put option for a stock you already own. This allows you to protect against downside risk while keeping the upside potential intact. If the stock falls below the put strike price, you can exercise the put to sell your shares at that set price to limit losses. The main benefit is downside protection, while the main risk is the cost of buying the put option. Spreads. A spread involves buying one option and selling another option of the same type on the same underlying stock. This helps reduce the premium cost, but also caps profits. Common types of spreads are bull call spreads, bear put spreads, and ratio spreads. Spreads allow you to clearly define risk or reward. Straddles. A straddle strategy is when you buy both a call and put option on the same stock with the same strike price and expiration date. This aims to profit from a large move in either direction. You can enter a long straddle, expecting volatility expansion, or enter a short straddle, expecting stagnation. Straddles allow you to benefit from volatility, but are quite risky if the stock doesn't move much. This covers the key options trading strategies for beginners. As you gain experience, you can explore more advanced strategies involving combinations of calls, puts, and underlying stocks. The best approach is to start simple and build knowledge over time. Finding the right options to trade when you're first starting out with options trading. Finding the right options contracts to trade can seem overwhelming. With thousands of different options across various strikes and expirations, how do you even begin to narrow down what to focus on? Here are some key criteria to use when researching options. Volume refers to how many contracts are trading for a particular option. Options with high volume tend to be more liquid, making it easier to get into and out of positions. As a beginner, stick to options that have at least a few hundred contracts trading per day. You can find volume data on most online options trading platforms or options data services. Liquidity is similar to volume. Liquidity refers to how easy it is to trade a particular option. The bid-ask spread is one measure of liquidity. Options with a tighter bid-ask spread tend to be more liquid. The bid is what buyers are willing to pay, while the ask is the lowest price sellers will accept. A wider bid-ask spread means lower liquidity. Volatility. Implied volatility measures how much the underlying stock price is expected to fluctuate over the life of the option. Options with higher implied volatility tend to have greater price swings. As a beginner, sticking to options with moderate volatility can help manage risk while still providing trading opportunities. Historical volatility looks back at actual past price changes. Strike price. The strike price is the price at which you can exercise an option to buy or sell the underlying stock. Picking the right strike price relative to the current stock price is key. And at the money strike near the current stock price offers a balance of leverage and probability of profit. Out of the money and in the money strikes skew risk versus reward. Research volume, liquidity, volatility, and strike prices when selecting your first options to trade. Focus on moderately liquid options. At the money strikes on stocks you want to own. Review historical price trends and implied volatility levels to make informed choices. With practice, you'll get better at picking the right options contracts for your trading plan. Risk management. Managing risk is crucial for options trading beginners. Options are leveraged instruments, which means you can control a large position with a relatively small amount of capital. However, this also means losses can accumulate quickly. Here are some key risk management principles. Importance of managing risk. With options, you can make or lose significant amounts of money quickly. Beginners should start small to limit potential losses as they learn. Focus on managing risk before profits. Master risk control first. Position sizing only risk 1-2 of your account on any single trade. This position sizing ensures no single loss wipes out your account. For example, if you have a $10,000 account, risk no more than 100,200 per trade. Stop losses. Use stop loss orders to limit downside. For example, if you buy an option for $1.0, set a stop loss at $0.5. This exit strategy prevents a 100% loss if the trade moves against you. Defining maximum loss. Know how much you can potentially lose on a trade before entering. For a long call or put, the maximum loss is the premium paid. For spreads, the max loss is the difference between strike prices. Define and accept the loss before entering. Proper risk management is key for options trading. Beginners, start small, use stop losses, size positions appropriately, and know the maximum loss of every trade. Mastering risk management helps create sustainable growth as a trader. Options trading platforms. When getting started with options trading, you'll need to open a brokerage account that allows options trades. There are many reputable online brokerages to choose from, each with their own account requirements, trading platforms, tools, and resources. Overview of online brokerage. Some of the most popular online brokerages for options trading include Charles Schwab E-Trade, TD Ameritrade, Fidelity Interactive Brokers. These brokerages allow self-directed trading and give you access to trading platforms, research tools, educational resources, and mobile apps. Most cater to active traders and have no account minimums. However, approval levels and fees vary. Required account approvals. Most brokerages require you to apply for specific account approvals before trading options. Options trading approval allows trading options contracts. Margin approval allows trading options on margin, which can magnify gains and losses. Level 2 or 3 options approval gives access to more advanced options strategies. Higher approval levels require a more extensive application process. Beginners can start with a basic options trading account. Tools and resources. Key trading tools and resources provided by online brokerages include trading platforms with options analysis tools, option chains, and order entry forms, options trading courses, education, and virtual trading simulators, screeners to find options trading opportunities based on criteria. Options strategy builders to visually model potential trades, mobile apps with alerts, notifications, and account management. Comparing the trading tools and resources can help find the best fit for your options, trading needs, and style. Making your first options trade. Step 1. Choose a brokerage account. The first step is to open a brokerage account that allows options trading. Some of the top brokers for options trading include TD Ameritrade, E-Trade, Charles Schwab, Fidelity, and Interactive Brokers. Consider factors like commissions, tools, research, customer service, and education when selecting a broker. Step 2. Decide which option to trade. Once your account is open, you'll need to decide which option to trade. Some key things to determine are the underlying stock or ETF, the expiration date, whether you want a call or put option. The strike price. For beginners, choose an underlying asset you feel comfortable with and an expiration at least 1-2 months out. Step 3. Place the options trade order. When you're ready, log into your brokerage account and enter the options trade order. Your order should include action buy or sell, option type call or put, underlying stock symbol, expiration date, strike price, number of contracts. Double check order details before submitting to ensure accuracy. Step 4. Monitor and manage the trade. Once your order is filled, monitor the trade closely. Options prices can change rapidly. Consider taking profits before expiration or closing out at a loss if the trade goes against you. Managing trades is key for beginners. Step 5. Close out the position. Options eventually expire, but it's best to close positions before expiration day. To close out, place a closing order for your position, then evaluate your trade results to learn and improve. With these basic steps, you can begin trading options. Start small, manage risk, and learn along the way. Tips for options trading. Beginners. Options trading offers the potential for significant rewards, but it also comes with considerable risk if you're new to investing. Here are some tips to avoid common mistakes and set yourself up for success as a beginning options trader. Avoid overtrading. When you first start trading options, it can be tempting to jump into multiple trades because of the leverage options offered. However, overtrading can be dangerous because it increases the chance that you'll incur significant losses from trading too often. Take your time to identify the best opportunities and limit yourself to a few quality trades per month. Patience is key. Start small. Only trade options contracts that represent 100 shares of the underlying stock when you're first starting out. This helps limit your risk exposure while you're on the learning curve. You can always work your way up to larger contracts after you gain experience. Beginning with small trades will also help you manage your emotions more effectively. Develop a trading plan. One of the biggest mistakes options traders make is failing to have a trading plan. A trading plan helps you implement your strategy consistently by laying out things like what options to trade, when to enter and exit positions, how to manage risk, and more. Trading randomly without a plan is a recipe for losing money. Manage your risk. Options trading comes with the risk of substantial losses if the trade goes against you. That's why having proper risk management rules in place is essential. Only allocate 1-5 of your account balance to any one trade. Use stop losses to limit potential downside. Purchase options with farther out expirations to give trades time to work. Risk management helps protect your trading capital so you can stay in the game long term. Avoid emotional trading. Don't let fear, greed, hope, or other emotions drive your options trading decisions. Trading based on emotions almost always leads to bad outcomes. Stick to your trading plan and strategy even during periods of market turbulence. If you're prone to emotional trading, tools like stop orders can help take the emotion out of buying and selling. Start with a paper trading account. Signing up for a paper trading account allows you to simulate options trading without risking real capital. This can be a great way to practice strategies and get comfortable with order entry mechanics before putting your money on the line. This helps novice traders get experience trading options in real market conditions without the stress. Learn from your mistakes. You'll inevitably make some mistakes when first trading options. Instead of beating yourself up, reflect on those mistakes to identify what you can learn from the experience. Review your trading journal and think about how you might improve your strategy or process to avoid future missteps. View mistakes as learning opportunities on your path to options trading mastery.